A warm welcome. Today we are in conversation with Mr. Amit Goenka, who is the founder, CEO and Managing Director for Nisus Finance. Pleasure to have you here, sir.
Thank you so much, Sunay. It's a pleasure to be here with you on ET Edge Insights, and it's one of the most prolific platforms in the country today. So thank you for making us a part of this. Thank you.
Thank you for that positive words for us. Today the theme would be that evolution of investments and the real rise of alternatives. So we'll be discussing and trying to understand a bit more from you when it comes to these subjects. So my first question to you is, how has the evolution really been in terms of investments, and what are the factors that have really put the overall change in the picture here?
Fantastic question, Sunay. So let me first start by saying that the whole alternative investments landscape really started to evolve post 2012 when the alternate investment funds regime was mooted and propagated by SEBI in that year. That's when AIFs really came into being and alternate investments started. We did not have that opportunity, save and except for certain PMS schemes which were trying to achieve the same objective till that period. If you see now in the last 10 plus years, we have seen a phenomenal 105% annualized growth in the AIF space, alternative investment fund space, year on year, to today the AUM being close to 7 lakh crores. That is a significant size compared to the mutual fund industry, which is far more wider, far more deeper, and far older, which is at 37 lakh crores. It is anticipated that the AIF industry will actually touch that number and maybe even exceed it over the next decade. That clearly shows the impact and importance of the alternate fund industry today. One of the key driving factors, Sunay, to what you asked was what makes it relevant. I think the first point is clearly the fact that there has been a growth in per capita income in the country. Today, people have the ability to put more money to work as investments than ever before. It is clearly a 20% annualized growth in per capita GDP, person to person, in the last 2 years alone. Because of this large disposable income, it cannot be sitting idle in the bank at a low rate of return or in other mutual funds, etc., which have not given extraordinary results over the last 10 years. So clearly there is a hunt for better returns and better managed portfolios in the hands of investors, which is driving this. That's the first part. Second is, if you look at the traditional landscape, it was only a choice between equities and debt. Either you could buy into a mutual fund or directly into equities, or you could get into a bank or a bond. Today, the alternate space clearly today transcends that into a very wide portfolio of products.
Sure.
People are happy to dabble into some digital assets and digital currencies, to pre-IPO stocks, which have given phenomenal returns as well, to hedge funds, to alternatives, to credit, to structured credit, which is again given very high returns, to derivatives, to commodities, and a very wide plethora of opportunities which were not available so far through traditional finance routes.
Wonderful. I think you've also focused a lot on the emerging trends really. What I also want to understand is, what should an investor be wary of? Where are the things where our focus should be as an investor when it comes to the emerging trends in investments?
Absolutely. So I think there are a lot of funds which are also trying to address the thematic requirements of investors, whether it is in the digital asset space or in the tokenization space. But it is important to understand first is that, is it regulated? Is it well managed? Does it have the requisite track record? Does the manager have the requisite track record and experience of having generated those returns and having proven its mettle over a period of time? I think that's a very important factor, because one of the things about alternatives, and to propagate that, of course, the entry barriers have been created, but they're not large enough compared to traditional asset classes like mutual funds or banks. Also, on the back of failure of several banks, it is important for fund managers to step in and optimize on that opportunity of high yield credit. It is important that anybody doing that should have had the requisite track record and experience of actually having generated that alpha in a special credit fund. So I think it's important from a consumer or from an investor standpoint is to A, look at the track record, B, look at the skin in the game. One of the biggest driving factors in my mind for alternatives to thrive was the mandatory requirement of the manager to put their own money on the table first.
Right.
Now, is it significant capital of the manager which is available and employed in the fund, is another very important checkbox from me. Third is, if you look at the risk reward ratio, is the fee structure and are the returns commensurate with the risk being taken? So I think given a combination of these two, it will need some level of sophistication, but now I do believe that given the plethora of opportunities, today investors are far more informed, far more sophisticated, have the ability to actually due diligence these factors before making an investment call.
Wonderful. Another question, and I want your bird's eye view on this one, is when it comes to technology and the overall arena in terms of investments, how they are being managed. What has technology really played a role here?
Absolutely. Very good question again. And post-COVID, I think technology and now more AI has become the talking point of every bedroom and every conversation in the country. It's important to understand that, when we saw banking a few years ago, it was necessary to go to a branch. Today, none of us have even seen our bank branches in several months or years. I think the same thing is obviously applicable to alternatives, where availability of real-time information, because it is important that when strategies are being implemented by alternatives, what exactly is the underlying asset class, where is it going to work, and what is it generating on real-time basis. So access to that real-time information. Second is ability to actually pull information and queries through a chatbot. I think it's important for investors who have the curiosity, because it's not a mutual fund where you're only waiting to get NAV statements. You not only need to understand NAV, you need to understand the tax incidence. You need to understand, because there's an accrual based accounting also involved in that. You need to understand what is it that is actually being generated on a multiple basis. What is the multiple in your capital on an actual NAV basis. It is important to understand what is the diversification that has happened over a period of time, because it's not a single amount going into a basket of existing opportunities, whether it's a basket of bonds or a basket of equities, but it's actually an emerging portfolio where capital is being drawn down periodically and that basket is getting built for you. So it's important to also therefore understand what is that basket actually doing and how is it growing and what is the concentration risk involved. So I think technology is a very great enabler where we're able to get real-time information. It's cloud-based computing, it's cloud-based analytics on each transaction, on the portfolio as a whole, and how is it actually expected to perform. So there's also a forecasting tool usually nowadays built in most fund managers. So the ability to get those dashboards at will, ability to download your tax forms, ability to actually understand the overall multiple on your investment is a very important feature which no other traditional fund managers are otherwise able to provide.
Wonderful. So coming back to alternative investments, how do we compare them to the traditional means of investment in terms of say the risk, return, profitability, the potential involved and the liquidity?
Absolutely fantastic. So I'm referring my conversation now to a recent Crystal report which talked about the big shift in financialization in India. Right. And all it did was it talked about how from traditional asset classes and traditional sources of investing, India Inc. and India consumer is now moving to alternatives. Understood. And which is where the growth is really coming from. So that is obviously predicated on A, the opportunity, B, the risk, C, the reward, and D, obviously the declaration and generation of those real returns. So when I look at these parameters, and of course technology is a large enabler, which is where today SEBI has made it mandatory that all units of the mutual fund, like mutual fund, even AIF unit, should be dematerialized. It is pushing for greater governance. It is pushing for real-time reporting, right, which is also available to the customer, unlike others. It is also pushing to maybe list it. There's now been a move to engulf the entire digital asset space and tokenization space within the micro and SME, REIT and AIF regimes, which basically means that anybody with 10 lakhs, 15 lakhs, 20 lakhs can now today also access an AIF platform, which was earlier only limited to the 1 crore plus investor, and make it available so that the benefit of these alternate credit and return funds and yield funds can be made available to a larger population like REITs. Without actually getting compressed to a REIT-like return, people can now generate a larger alpha. So if you look at from a risk-reward perspective, today the emergence of this space clearly means that the risks are far lower, the opportunities are far greater, and the ability for a larger demographic profile to invest into alternatives has grown over time. Second, the constraints really still today is that it is not as liquid as you would have maybe a bond fund or an equity fund or maybe a deposit, right? Or having said that, if I compare a credit fund, which is what we run, with any other listed bond issuances by several finance companies or manufacturing companies, there again, because of the lack of depth in the debt and capital markets or in the credit market, the liquidity there is also reserved. However, the returns are obviously superior. Now, if you compare that scenario with an alternative credit fund like ours, A, These are short cycles. You're seeing your money come back every year. You're seeing your full capital getting redeemed with almost 2.2x returns over a period of 4 years. So for the medium to long term investors, this is the best alternative on a risk adjusted basis. But for those who are retirees, for those who are looking at short term liquidity, for those who are looking at cash at will, irrespective whether they make a profit or loss, then alternatives is still not the answer. It's still a while away. So that's the risk factor, and I would therefore not encourage people who are retirees, pensioners, or people with short-term liquidity requirements to actually look at alternatives. These are really wealth-generating options in the hands of people who do have surplus capital.
Wonderful. Then it sounds like a great option for my generation at least.
Absolutely. It is certainly for your generation. And I would say that surprisingly, when we started about 10, 11 years ago, the largest investors were large offices and significantly senior people.
Right.
So then I'm very happy to tell you that today the average age of our investors actually fallen to about 37 years, which is amazing, which is also reflective of the time at which people are buying their homes. Today people at the age of 30, 35, 38 are willing to buy their first homes. They're willing to make these investments.
Absolutely.
Because they do have the sophistication, the knowledge, and the understanding of what happens globally. How are international folks making money? How is it that I can trade something in the US and global markets? How do I make money out of an alternatives like a painting or a Bitcoin or out of some other digital assets, which otherwise I don't want to consume, but I have the ability to make margins on that. So that's really the space where alternatives come in, because we are obviously identifying these opportunities to make that supernormal return, which is really the reason why people will come to us.
Absolutely.
So absolutely. Thank you for that.
So, trying to understand a bit more about your organization, what are the steps you have really taken to make this a scalable, sustainable and an efficient, organization, and also in terms of, facing the global economic slowdown, reducing and mitigating the risks associated, the losses associated. So how do you
Wonderful question, and something which a lot of people do ask is, are the current global geopolitical or economic headwinds likely to affect India and our investment strategies? Now, if you see where we are today, we're in the cusp of a great tectonic shift when it comes to the credit markets. We've seen several large banks fail. We've seen several large NBFCs fail. We've seen large credit platforms almost disappear overnight because of governance issues. So today, from a central bank and a regulatory standpoint, governance has become the single most important talking point for all credit funds and investment managers. Now that obviously leaves a very large void. Today we've seen ads of a large financial bank getting created, one of the top 5 in the world. Now that also means that with that NBFC exiting, it creates a very large void for alternative credit in the country. Now that has obviously fallen upon us as a mantle to provide that capital, to provide that liquidity where credit is required in the hands of the largest, the most well governed, the most diligent borrowers and counterparties in the country. So very strong corporates with need for capital, for growth, to meet asset liability mismatches at our door. We have the ability to actually take these loan assets which are available in the hands of all these exiting lenders and actually restructure them, create that liquidity in favor of those companies which have got impacted because of these institutions. So clearly I think that's a huge landscape. In my space alone, Kunal, there's a $15 billion opportunity of these loan assets which are requiring resolution, which are brilliant in terms of the underlying, in terms of the cash flows, in terms of the counterparty, but have been stuck in, let's say, a bad bank. Now that is the opportunity for us and for the investors at large, that something which was earlier underwritten by these banks at, let's say, 10%, 11% could now be traded at 20%. Because somebody's taken a haircut, there were inefficiencies. So clearly it's a huge scalable opportunity. The other important point is it's all domestic, intrinsic and our own consumption based economy. So we're not focusing on export oriented stuff. We're not focusing on dollar based economies. We're focusing on the India credit and the India consumer, which I don't think anybody has a doubt that for the next 10 years, India consumer story is intact. When you read the reviews and the views of the top technology companies, of the top consumer companies, of the top development companies, of the top infra companies, they're all believing and they're all saying and forecasting that India is the biggest destination for consumption in the world, given our demographic dividends. So on the back of these domestic cash flows in a running enterprise with a strong order book, which is already executed or under execution, with cash flows already available, with receivables already standing in their books, I don't think we're worried about global shocks. So we're betting on India, we're betting on the India consumer, we're betting on the ability of our consumers, our creditors to continue their unabated growth, and we're talking of the top 5% today, because their markets have also consolidated post 2022. And these top 5%, 10%, 15% players is what is going to continue to grow the Indian economy upwards and onwards, backed by obviously the aspirations of the youth, the consumption power, the earning potential of the country. Right. I think that's really where the story is, and that's really all in the favor of alternatives, which is why we don't see any risk. When it comes to, in fact, I think that the global headwinds have only shown more opportunities upon us. Today, global capital is actually looking to play India. We're calling ourselves China plus one. The world is looking to make India their playhouse, make India a manufacturing base, consumption base. So all of this needs more capital. All of needs means that alternatives need to come more to the fore, yeah, and participate in these growth opportunities, which is clearly the advantage in our favor. So I honestly don't think that anybody who's inward looking and looking at India Inc. and the India demographic dividend is actually at risk, and so neither are we.
Wonderful. My question would have been your view in terms of the overall finance as a sector, but I can sense the optimism, I can sense the positivity.
No, that is true. That is true.
India
Sunay,
growing
but
strong.
I have to be cautious again, because we've seen a lot of bank failures in Western markets very recently, and we've had our bad share actually pre-2020 already. Bulk of that cleanup actually happened even before some of these crises have hit Western markets. So to that extent, we've created greater resilience in our favor. But I have to be cautious about the traditional finance space, on one side, because in terms of product design, in terms of risk, in terms of systems, in terms of technology, I think they're still playing catch up. Sure. They're still playing catch up, and I think that's one issue, because they're still not able to be nimble enough when it comes to the regulatory environment, when it comes to the actual demand for product and risk in the market space. So I see that as a laggard or as a lagging issue, which the regulator is constantly trying to harp and trying to beat upon, is to see how they actually catch up. So I would obviously continue to be slightly cautious when it comes to traditional banking systems, or when it comes to traditional investment systems. I think there are still certain lacunae there. The other risk profile, to be honest, remains also in the alternate space. As I mentioned, that the entry barriers to an AIF manager is slightly lower, and therefore it's very critical that any investor who says, okay, I need to make an alpha, is actually going with the right manager. Somebody who's shown about a decade plus worth of track record, who's shown that they've managed and exited enough funds in time without any issues or constraints, irrespective of the economic cyclicality. Because we've seen a lot in the last 10 years. Right. We've seen GST regimes, we've seen demonetization, we've seen, obviously a huge force majeure event. So if somebody has stood and withstood those events and still come out strong on the other side, I think that's the manager to back, in my view. So I think that's an important benchmark. So I would not get dissuaded by some of the new flavor of the season offerings. I think it must be important that in financial services to be a little more defensive. Some things look very attractive, they look very glamorous, but more than that, as financial professionals who've actually come from the traditional forays, that it's important for investors to still stay defensive and look for capable fund managers. So that's the only caution. Otherwise, it's a fantastic time.
I'm sure, I think for anyone, one needs to be wary of their wealth, their money, and they need to go to the expert.
Well, absolutely right. Well said. And of course, Economic Times is one of the leading publications, maybe one of the only publications which does a very deep analysis very frequently on alternatives versus traditional. And some of those readings itself can throw so much insight into exactly how alternatives are performing, and what is it that the journey that they're likely to take, and where is it that money will find its way into. So my compliments to the ET team and the ET Insights team for ensuring that your readership is absolutely sharp and abreast of current changes.
Thank you so much, and it's an absolute pleasure finally to have gotten a few minutes of your time and your expert comments on various topics, and maybe we get a chance again to do this.
No, my pleasure too, and all the very best. Thank you so much.
Thank you so much.
Thank you.